All right, everybody, welcome back to Whiteboard Finance. Today we're diving into something kind of weird. The Fed's been cutting rates since September 2024-ish, but mortgage rates? They're still climbing. What's going on? Is this some kind of financial magic trick? Let's crack this nut wide open. So yeah, the title of this video is going to be Mortgage Rates Up When the Fed Cuts. Okay, so here's the scoop. Like I said, the Federal Reserve started cutting the federal funds rate way back in September of 2024. This was after a bunch of hikes through 2022 and 2023, all aimed at battling inflation, that pesky price gouging monster. But weirdly, mortgage interest rates have actually been increasing during that same time. What the heck is that? You can see here we're talking about a 50 basis point cut back in September 2024. Now, for anyone who's not a financial wizard, basis points is just a fancy way of saying 0.01%. So, 50 basis points, that's 0.5%. Then November 6th, we saw another 25 basis points, then December 17th, another 25. That brought us to a target range of about 4.25% to 4.5%. Cool, right? Now, quick FYI. The Fed funds rate is basically the rate at which banks lend money to each other. It's like the Fed saying, hey, here's our base interest rate. Go forth and lend. But here's the crazy thing. Mortgage rates do not directly follow the Fed funds rate. I know, it's mind-blowing. When you hear people saying, oh, the Fed cut rates, my savings account interest is going to drop, that's true for some things, but it's not how mortgage rates work, my friends. Mortgage rates dance to the tune of the bond market, specifically the 10-year Treasury bond. Bond yields, and thus pretty much mortgage rates, are moved by all sorts of factors related to the bigger economic picture. We're talking fiscal policy, the FOMC, Federal Open Market Committee, and their decisions. It's a whole ecosystem. We will talk about those policies, so stay tuned. Basically, mortgage rates are figured out by adding a spread to the 10-year Treasury yield. Historically, that spread is around 1.5 to 2 percentage points. This covers investors for the higher risk of mortgages. So if the bond yield is 4%, you can probably expect mortgage rates to be in the 5.5% to 6% range. See how it was basically zero from 2020 to 2022? Didn't do much for mortgage rates, which hung out around 2.5% to 3%. The main takeaway from this is that even if the Fed's cutting those rates, it doesn't automatically mean you're going to score a super cheap mortgage. The 10-year Treasury is still high, so here's a headline from CNBC. Why are mortgage rates up despite falling Treasury yields? See, it is a question a lot of people are asking. The article points out that strong job growth makes it less likely that the Fed will lower interest rates at its upcoming meeting. Basically, good news for the economy can be not so great news for mortgage rates in the short term. Some experts are predicting only one rate cut for the entire year of 2025. You got it right. All right, let's move on. Okay, the bond vigilantes are back. There are 4 underlying reasons this is happening. Economic strength. Higher yields are needed to lure investors away from stocks. Federal Reserve policy. The dual mandate of maximum employment and stable prices. Inflation. Resurgent inflation demands higher yields from the 10-year. Government spending debt. If government debt is high, the interest rates need to increase to compensate the investors. Hopefully, you can see now. These reasons explain why these rates are going up. Remember, when we invest, we're simply just being compensated for the amount of risk we're taking on. Think about it this way. If I invest in my friend's brand new company, which he's starting in his basement, as an early investor, I need to be compensated highly because there's a high risk of him. If I am investing in a savings account where it's essentially risk-free, I should expect a lower rate for that lower level of risk. Make sense? Okay, so you've been super patient, and now you're wondering how could mortgage rates go down. Mortgage rates have stayed high due to recent economic data releases showing stubborn price growth and low unemployment. Inflation and employment slow down due to weaker economy, less government spending, and geopolitical stability. Okay, so the big question, how do mortgage rates actually go down? It all boils down to the mortgage treasury spread. Historically, this spread has been around 1.5% to 2%, but right now we're seeing it closer to 2.5% to 3%. Think of it like this. The mortgage treasury spread is the extra cost lenders are charging above what they could get investing in super safe treasury bonds. This is where profit comes from risk of lending. The reason I'm making this video is that a lot of potential home buyers are on the fence. They're hearing about the Fed potentially cutting rates, but they're not seeing mortgage rates drop. So, is now the right time to buy? Here's my take. Here is something quick. Inflation goes up, assets go up, stocks go up, real estate goes up, as it all is tied to a financial system. Let's pull an example. If you look at houses that were for sale around 2013, those things have doubled and tripled in price. Is it possible to get to the best time to buy, which would be ridiculously low prices and low rates? Now, some of you might be worried about another 2008-style crash. I don't think that's likely because the loan-to-value, LTV, on most homes right now is much lower. Back in the Great Financial Crisis, LTVs were around 80–85%. Today, the average is closer to 45%. So if a house is worth $100,000, the average homeowner owes only $45,000 compared to $80,000, $85,000 back then. Makes a huge difference. People are paying their mortgages and have more equity. Look, I get it. It's tough out there for potential home buyers. Money isn't cheap right now. You can say that mortgage rates are high. You might hear people say, oh, mortgage rates used to be 7%, 8%, even 16% in the 90s. True, but you have to consider the context. Look at what you can earn in savings accounts or treasury bonds. Look at median household wages. The amount of income needed to buy a house right now is at an all-time high. So, you're stuck between a rock and a hard place. The cost of money is high and mortgage rates are high relative to wages. A lot of people are making the argument for renting over buying, and I get it. That's a whole other conversation for another video. We can dive into the pros and cons of renting versus buying. Let me know in the comments if you want to see that. Okay, this is insane, but it is something that needs to get said. Historically, the average cost of a house in the U.S. has been around 5 times the yearly household income. During the housing bubble of 2006, this ratio exceeded 7. And guess what? We're at 7.225 as of September 2024. Yeah, so in 2016, the ratio was 5.4. Now it's 7.23. Mind-blowing. And finally, something that gets on my nerves. Sorry for the rant, but people argue, oh, houses are bigger now. You're getting more house than ever before. No, dummy, look at the price per square foot. That's all you need to do. Compare the price per square foot 20 years ago to the price per square foot now. It doesn't matter if you have a pool, a basement, or whatever. Price per square foot is the true indicator, and it's ridiculously high because it's tied to the financial system. Hopefully you got some value out of this video. If you did, please like, comment, and subscribe. Share this with your friends who are thinking about buying a house or looking at mortgage rates. And as always, have a prosperous day. Peace.